Sean, but before I hand over to you
Yeah.
completely, I've got a couple of questions for you, because I've been kind of following the progress of the Global Supply Chain Finance Forum for some time. And I do remember, it must be, I don't know, about 10 years ago when this was formed?
Yes, a little bit less than that.
A little bit less than that, okay. And I don't know how many of you are familiar with this forum, but when supply chain finance started to be, people became aware of it, and it started to be talked about a lot in various conferences and seminars. Inevitably, somebody would be describing supply chain finance and what it did and how it worked and the mechanics. But someone would describe it in one way at one event, and another person would describe it in a slightly different way at a different event, and this created quite a bit of confusion. And so very often, you at these events, someone put their hand up and say, "Okay, you're mentioning SCF a lot. Can you please tell us what it means, because we're confused?" So the GSCFF was formed, I think, as a result. I think the ICC were involved in this, or it was their initiative. Was that right?
It was an initiative of all the associations. That's my first couple of slides, but yes.
Okay. Sorry if I'm stealing your thunder, but that's what happened, wasn't it? There was a lot of confusion about supply chain finance, and somebody decided that we've got to get a handle on this and try and get a common definition that everybody is happy with. So who was involved in those initial discussions?
So if I can maybe get the first slides up. Is this clicker working? What do I click at? All right, maybe we'll sort that out in a second. But yeah, so this is what I call the Tower of Babel problem, in that we're all doing the same thing, but we're speaking different languages. And there was a reason why actually a lot of banks, the suppliers, actually didn't want to have clarity, and that's because they could go in to their customers and offer apparently a different product. Now, what was happening is that as multiple banks were doing this, their customers were getting confused. They were saying, "Well, you're Bank X, but last week Bank Y came in and they sold me seems to be the same thing. They called it something else." So I think eventually people sort of calmed down and got on board with the program, and decided that actually what we do need is very least a common dictionary, and then that led into, well, we need to describe and educate, and we need to deal with new techniques. The area, and we need to, the first big question that we had to decide, and I've sort of mentioned this already, is what is supply chain finance? Because here we've called this a supply chain finance forum, and we are going to be talking really about one form of supply chain finance, what's called payables finance, in the definitions. But actually supply chain finance is a big ecosystem. I want to use that word again. There's a lot of different techniques, and we're on. Right. Ta-da. This is it. So this is the standard definitions. And you can see that FCI and IFG. IFG is the precursor association of FCI. They merged into it. So that's factoring, ourselves, the EBA, as I mentioned, and ICC. So we produced this in 2016. We've refined it. We've added to some of the definitions. But the idea is, as I say, to provide this common language. So this was very well bought into by the associations that are and banks that are active in trade finance. And we got over this hump of, I'll call it what my client wants to call it, because that ultimately is not good for the development of the product, and that's especially true here. And you'll see some very big banks, my daytime employer up there, SMBC. But you've got some big banks, and you'll notice, interestingly, some big regional banks, not global banks, banks like DBS and Santander and so on, and factoring associates, people like Bibi and so on, Arab Banking Corporation for the Middle East. So there was a big buy-in into this, and I think eventually everybody got on the program. And so I think whilst it's not known to everybody yet, it's not quite the holy book. quite yet. It's becoming increasingly quoted. The idea also was to reach out to regulators and legislators. So when the EBRD, for example, pushes out supply chain finance, the legislators want to know what that is, because it means, it can mean a lot of different things. So that's the purpose of it. Now, let's start with a definition here. And as I said before, mainly what I'm talking about today and what this conference is about payables finance. But it's important to realize that actually SCF is a very, very big ecosystem, right? It's payables, it's receivables, it's inventory financing, it's pre-export, it's post-shipment finance. It's a lot of different things, and these are all a spectrum. So what I say often is to people when they pick up the definitions for the first time is look on this not as, I've called it a holy book, but maybe what I'd be better to call it as a list of ingredients, as a menu, because you can pick and choose from this. And what's important, and I'll show you in the next slide, which I'll just forewarn you, this is what I call, and you'll say I'm very sad, but the next slide is what I call the most exciting slide in trade finance. So just so that you can anticipate that, and the suspense will build up, and then you'll say, Sean, you need to get out more. But the point is, there are really, when we talk about supply chain finance, there are really two chains, right? There's the physical supply chain, and there's the financial supply chain that sits on top of that. And this very exciting slide shows that. But let's just start with the definition, because this is the Tower of Babel issue. So if you look here at the very top, what's the definition, as we would say, of supply chain finance? And you don't need to be religious about this, but bear this in mind when I say you can pick and choose. And sometimes a receivable is the way to go, sometimes a payable is the way to go. And there are different parts of the supply chain timeline that you can penetrate using different techniques and different products. So it's the use of financing and risk mitigation practices and techniques to optimize working capital and liquidity invested in supply chain. So that's very broad. This is working capital, right? It's not uniquely, if you like, trade finance. A couple of points to pick up. It's risk mitigation as well as financing. So the use of insurance is really important. I mentioned early on when I introduced ITFA that we have a very large insurance community, and increasingly, in fact, we've produced our first Basel III compliant policy for receivables finance. So this is an area where the importance of insurers cannot be understated. I'm not going to go on about this at any length because this is not the purpose of this conference, but they are a big partner for all major banks now. They are really an enabler. They're a risk and volume multiplier, so they become really important. I've underlined some of the really important things to take away from this definition. It's a holistic concept. So I've already mentioned this. It's a broad range of established and evolving, and in these 2 days we'll see how fast it is evolving and how it's evolving. Evolving techniques for provision of trade and management of risk. That's very important as well. Because increasingly what digitization is allowing us to do is to plug in a lot of other functions, functionalities, software. We talked with Lever ID this morning about understanding ID, about trust. Oscar is nodding very vigorously at the back there, about understanding trust, about what the whether you can trust a signature or proof of the signature, the level of that signature. That's part of risk mitigation. But of course, excitingly, we can add all sorts of other functionalities, such as ratings, and this is becoming increasingly important in something Uwe mentioned, which is the non-bank investors. So they would like to see very conveniently a product, a trade finance product. They can look in one place and they can see what the risk is. They can see that it's been rated. In ITFA, we're starting conversations with Moody's on rating trade assets. Because that's a really important part of the investment of those people. So it's open account. It's usually, but not exclusively, applied to open account trade. That's a slight contradiction in terms, because pure open account, of course, you don't really need a bank other than bank accounts at both ends. Banks don't intermediate it. But supply chain is a way for banks to do that, to add services that are value adding and have benefits, not only make a profit for the bank, but benefit the buyer and the seller, so they'll want to use them. And there's always this sort of seesaw between pure open account, some of this, a lot of this is about trust as we get increasingly globalized, but what some would argue in the last year or two, less globalized. We need to actually have banks involved in that, and they can be, provided that the technology they use is convenient and good. They can actually really add value. It's very importantly event driven. So the supply chain is obviously the whole thing, but there are different events, and this is my exciting slide. There are different events along that chain, such as purchase orders, invoices. So really right from the beginning, from the source to pay and so on. There are receivables, and then there are payables, post-shipment, pre-shipment. There's a lot of different things that can happen. And finally, and this is really the reason that we're here, it's an evolving concept. It's not something that stands still, even in relation to the techniques, and especially true in relation to payables finance. There are lots of sort of subcategories, if you like. There are different ways of doing this. One of the things I'll mention, it's a slide I've taken from the internal SMBC credit application, where we've used this to actually enhance operating OPEX. So you'll see, I've obviously anonymized it, but it's a real case study. And that's used something that we call at SMBC milestone financing. So this is almost like mini project financing. So these are very flexible techniques. And I should just say, in relation to ITFA, so when we started in the forfeiting market 30 years ago, at that time, the enabler, if you like, the interoperable standard was the promissory note and the bill of exchange. Now, they seem these days terribly old-fashioned, but we'll talk later on about how we'll modernize that. But at the time, remember, a much less global world in the 1980s, 1990s, there were very few global standards. But because of colonial era laws, mainly British and French, these negotiable instruments were understood. You will have a concept of that. So I think in Estonia, it's seeped into all the commercial codes. Now, then it became, because it had to be paper, it became inconvenient, and markets developed. But there are ways in which those products change, how they adapt to new markets. So it is, and as I say, we are now on the cusp of being able to digitize those instruments that are understood, still can benefit from that international acceptance and precedent, important for lawyers. In countries where you don't have a lot of law, those sorts of instruments are understood because they've been around for, in some cases, a couple of 100 years, right? India actually has a law on bills of exchange that's 1 year older than the UK. It's the 1881 Act as opposed to the 82 Act for the UK. That's for various reasons. Right, are you ready for the most exciting slide in trade finance? Yes? You ready? Okay, I know you're going to be disappointed. Right, here it is. Yay! So I call this exciting because this is the marketplace for all of you banks, for the tech providers as well, because this shows you the financial supply chain opportunities. So in the little white boxes there, most of them are indicated by stars. That's the event. This is the financial supply chain overlaid on these colored boxes. And that you can see if you look at the top left as you're looking at it, planned supply chain. This is the very beginning of the supply chain process, all right? Obviously, this is simplified, and this is in any company, this is going on. All the time, and you're at different stages for different products. So it's never quite as clean as this, but conceptually, this is what it looks like. So you plan the supply chain, and at the end, you review the supply chain. What can you make better? But at the bottom, you'll see a lot of collection services. Now, the event-driven bit, which I said is important, is are all these stars. So you'll see at the beginning you've got market intelligence and analytics. Now for banks that wasn't very interesting. For a lot of you tech providers, that is interesting. That's the area really where you can add value. And that's an area where banks are very bad. Actually, banks have a lot of data, but it's badly organized. They can't mine it. Some of it's legal. The problem is illegal, but mainly the problem is technology. We don't have the ability to do that. And that's where really some of the tech companies, the data scrapers and so on, can really add value. So then you move from left to right. You've got the purchase order, and then the first opportunity for real finance here is pre-shipment finance. Now that's been a very difficult area for many banks actually to get into, trade finance banks, because there's been no delivery of goods, there's no invoice, the risk is quite different. So a lot of that has tended to be essentially very expensive overdrafts or working capital. With better analytics, actually, we can, and I'll show you later on about how this can be done through a platform. But through a lot of this now is becoming more accessible to banks. And it's an area where really there is a need for, it's really the area of supply chain to some extent. But this is the area, this is really the underfunded part of trade finance. So this is what, you know, the suppliers need to be able to produce the goods. Now you move along and then you get to, so the goods are produced and shipped. Well, they're loaded in a warehouse. You've got inventory finance, which is a complex area, again, for banks. Another area where technology can play a real part. One of the instruments that we'll be talking about alongside bills of lading is warehouse receipts. So warehouse receipts, actually there's no need for them to be in paper form, but traditionally they have been because that's the only technology that's been around. So that the platforms and the technology that we have now are really enabling that to be digitized a lot more easily. It's something that Wave can do. It's something that other platforms as well. I'm not here as a salesman for OFA because he'll do that very well later on. But it's something that they can, and it's relatively simple. A lot of this technology is quite generic. It's a commercial application. So that is sort of quite exciting as well. Again, remember this point, once you've digitized everything, whether it's on a platform or it's through some sort of individual software, you've got the ability to plug that into the ecosystem. All right, I'm not saying that's an easy thing to do, and we're not there yet, but that's the dream. You then move along, so you prepare to load, you ship. Now here, the right-hand side, you've got e-invoicing, so classical trade finance, e-invoicing, and this is the area in the middle, receivables finance, you'll see. This is the area where banks have been traditionally the most comfortable in, all right, because you've got an invoice, you've got an obligation to pay, you've got performance risk, of course, but you've got a document that people understand. And as we heard earlier on this morning, e-invoicing is the standards that have been developed extremely well in Europe and are being rolled out in the rest of the world as well. In South America, for example, there's, I think most business-to-business invoices have to be electronic, and that's because the tax authorities want to see them. Whether that's a good or a bad thing, I don't know, but that's what spurred digitization there. So that's been the traditional area where banks have got comfortable. Now, here at the bottom right, post-shipment finance, buyer-centric. This is what we're talking about. This is the payables finance, the reverse factoring, the confirmation. One of those banks in the earlier slide, Santander, claimed to have invented payables finance in Spain. They called it confirming, and I think they've actually trademarked that. But most people call it something else. But you know, it's been around. The point here, and I'll show you later on, is that there's an undertaking to pay by the buyer. So that performance risk that I've mentioned on the receivable then in theory disappears. And then of course you get to the bottom, and this is what happens after. This is largely about payments and trying to make things better. So a little bit of background to why are we concerned, why are we even bothering looking into this market. It's a big market. These figures are a bit out of date. I'm sorry, it's 2017, but the trend is upwards. But you can see there's still a lot being done in traditional trade, and that's letters of credit. The numbers now will have gone down, so there'll be a lot more. So here, 4.6 trillion of traditional trade, 813 billion of SCF. That will have moved in inverse direction. So there'll be less traditional trade and a lot more supply chain. If you look at the bottom table there, you can see the Payables Finance. Again, this point about what is supply chain. So this uses the GSCFF definition of the broad range of techniques. But Payables Finance, you can see, far and away the biggest, followed then by Receivables Finance. I'll just say in defense of the industry that I grew into, forfeiting looks quite low there. Actually, a lot of this, a lot of receivables discount actually is forfeiting. Okay, so again, some figures that are slightly out of date, but the trend is pretty much similar. Where are these things expanding in red? Where is it declining? This survey is about 6 years old, but as I say, the trends are, well, with one very important exception for us, will probably be about the same. So you can see there, APAC and MENA, there's a big, there's more increase, more expansion than decline. Now, on the right-hand side, you'll see, and this is a survey that we carried out, so it's subject to the usual limitations, but in 2015-16, our respondents said, in CEE, it's a declining market. And I think that was maybe true in 2015-16. I think it's less true now. When was Supplier Plus set up? 15. Well, there we go. It stopped the rot. So if we had Supplier Plus figures in there, it would be very different. This one I just wanted to show you. Again, it's slightly old, but the trend is the same. You'll see this is a volume business. So a lot of supply chain is about relatively small invoices. And so typically, we ask members, what's the volume that you do? So 300 plus, nearly half of the banks and members said, we do 300 plus. And some of those will do well over 300. Some, are specialized. So the 0 to 75 category is still not insignificant, 20%. And those will be the specialized houses. That's also, I think, one feature of this market. What's your volume in Supplier Plus? Can you say number of? You're the top end of the scale now, yeah. So, but there are a lot of small. Again, this was 2015-16, but it is the point here that's illustrated. It's a volume business, and turnover again. This is the value of the invoices. It's sort of more similar. It's more equal, but again, you'll see well over half. 35% is in the 5 to 10 million. Now but there's a lot. 20% in the half to $2 million category. The plus 10 million. That will probably be a few of the large banks because we have some very large banks in ITFA. I suspect. What's the sort of average size of your value for invoices that you do at one time? $7,000 euros. Okay, so yeah, so it's a relatively small. There are still a lot of relatively small values here. Okay, the last thing I want to say about the standard definitions. So the booklet takes you through all the different components of supply chain finance. Now, on the left-hand side of what I call this Sputnik here, you'll see the actual techniques themselves, and we've divided that into receivables purchase and what we call loan-based techniques. So a lot of those opportunities that you saw at the beginning of the supply chain really fall into the loan-based techniques because there's no receivable yet. So there's nothing to buy. So receivables purchasing, forfeiting, factoring, and there were so many factoring variations, it had to have an additional category. And of course, payables finance, there has to be some delivery, some instrument has to exist. The loan-based techniques, so that's how we made the division. That was my suggestion, so it's a bit legalistic. Lawyers will probably like that. But again, the important thing is, from a commercial point of view, is that these are all points on the spectrum. For each of these techniques, on the right-hand side, there's a definition, there's synonyms and so on. So we've tried really to compare these techniques against each other. And again, to go back to the point I was making about this being a really useful tool as a menu, and there's also a very useful table at the end, but about it being a menu that you can pick and choose from. You can actually use this to compare like with like. So it's again, really good. Let me go back, actually, I didn't tell you where okay, and that's it, supplychainfinanceforum.org. That's where you can find this excellent publication. All right. Now, let's get into working capital. So the heart of working capital. Now, a lot of you will know this, and apologize for taking you through a sort of 101. But this is the heart of working capital. This is why we do supply chain. It's not necessarily about trade. It's about optimizing working capital, about optimizing, optimizing the cash in a company. And for small companies, cash is king, right? Cash is absolutely king. So CCC is the cash conversion cycle, and that is composed of the DSO, days sales outstanding, plus the DIO, days inventory outstanding, less your DPO, your days payables outstanding. So basically, and then plus or minus the ROR. So the ROR, again, very interesting when we look at this from a digital point of view. These are the operational efficiencies that until relatively recently we couldn't often do a lot about. That's why it's a plus minus. It should be a minus, but I say it's plus because actually you can now increase you can really increase your efficiency here. So what everybody is trying to do, every company is trying to do, is it wants to be paid as soon as possible, right? That's the RSO. So it wants to reduce that. Its days sales outstanding want to be as low as possible. It also wants to pay as late as possible. That's the DPO. It wants to increase that. And of course, the inventory, it wants to get that out. It wants to have inventory in a warehouse because that's a cost, that's an overhead. It's not making any money for you. They want to reduce that as well. And you'll see here, to go back to the point about this is a chain and there are different opportunities and it's event-driven. There are different techniques at different times. And I'll show you later on how you can combine that. Again, go back to the point, it's a chain. This is a menu, pick and choose for the right moment. But forfeiting, factoring, invoice discounting, and purchase order financing, those will all help you with your DSOs. And here, mainly what we're talking about is your payables. Now, of course, what's true for one company will be the complete opposite for the other. So if I can reduce my DSO, if I can get paid early, that's going to have the inverse opposite effect on my buyer. My buyer is paying me early, so I'm losing sales, but his DPOs are not being benefited. He's having to pay early, and you can see that in this little sort of very simplistic example. But here you've got actually quite a badly managed company. So you've got here a cash conversion cycle of 85 days because you've got very early payment against DPO. So the cash paid for the inventory is quite short. It's a long time, so it's held in inventory in a warehouse or in the factory for a long time. And then there is a 40-day wait to be paid when cash received. So here you've got, this is a bit of an extreme example, but you've got here quite a seriously bad cash conversion cycle of 85 days. You can see there how it's worked out. So you disperse cash before cash comes in. The industry has come up with these formulae, but it's not really rocket science when you think about it. It's getting paid early and paying as late as you can. So you need funding here. And it's not a good situation, but it's a common one. So you need funding here. Now, this is the answer. We mentioned early on before that supply chain finance was a win-win situation. And the way that happens is that the supplier can get paid earlier, but the buyer can also extend its payment terms with the bank. So not with the supplier. So the supplier can benefit from the finance that's being offered, and get paid early. The bank doesn't have to pay until the original due date, or indeed very often an extended due date, and that's a very controversial area. That's had a little bit of it's had a big impact. Actually, it's been the subject of a big debate, which I'll talk about a little bit at the end, in relation to how you account for supply chain finance, how a corporate user will account for it. But basically here, and in the middle, there should be a platform. It's usually automated. But the basic idea here, and this is taken from the definitions, every technique has a diagram like this, so you can see it very, very simply. On the left-hand side, you've got buyer and seller. You've got the commercial side. You've got the buyer at number 3 approving the invoice, and that's the difference, of course, between a receivables and a payables program, and that's how you get rid of the performance risk. The buyer will usually issue what's called an IPU, an irrevocable payment undertaking, and that has various forms. Hint, the promissory note is also an irrevocable payment undertaking, and that's why we're really excited about digitizing it. People don't use it because it needs to be paper. We'll talk about that, Ira and I will talk about that tomorrow, and about how that's changing. But once that happens, once 3 happens, then the finance provider comes in and if, and this is an important point, if the seller at number 5, the supplier wants early payment, it will take advantage of that program, and it will be paid early, and very importantly, it will use, of course, the cost of funds, or the finance rate, will be based on the risk of the buyer, because the buyer has removed the credit. Ultimately, of course, the credit risk is always on the buyer, but in a payables program, you have because the buyer has set it up, and because he's given you that confirmation, that IPU, you've removed the performance risk, and you've just increased the whole security of the program, really. So slightly busy slide at top. You can see that I said about synonyms, so lots of different names for what we've decided we will call payables finance. Also, it's often just called supply chain finance, and that's sort of what a lot of people still call it. But for the benefit of the supplier, it's obviously improving the cash flow that would otherwise be tied up in an outstanding invoice, and it's improving the DSO. And importantly, as I said, what you're using is the buyer's cost of funds. Typically, these programs, it's a question actually I wanted to ask Uwe, what's the size of your buyers are here? But typically in the well-established Western European or American programs, these are very big buyers. The biggest supply chain finance program in the world is Walmart, who've got thousands, tens of thousands of suppliers. But they, of course, are very, very solid credit. In the UK, supermarket chains use this a lot, as I mentioned earlier on. So it tends to be investment grade companies that set these things up. Now, in principle, and especially with support from maybe the EBRD, Ian, I know you're still in the room, but yes, it's not really something that's supported as well as it could be. This is something that we can push down the credit curve, because all these principles here will apply to any size of company. Now, a couple of years ago, with Maria's help, we, at the 2018 or 19 ITFA Budapest conference, we had a couple of guys on, one from an Armenian bank, sadly not here today, and one from a Kosovan bank. It was from Kosovo, wasn't it, Maria? No, in Budapest. Yes. So we had, and what was really interesting from the Kosovan bank is, obviously it's a small economy, but the point is, within their market, they knew, and they had a lot of credit data on reliability of the suppliers and the buyers. So within their market, they actually, with using their privileged position in the middle, and often this is what banks can do, but unless you're in a very small market, it's very hard to do without some sort of technology. is to use that knowledge actually to predict what default rates are going to be, and that enables you to set up programs that are much lower down the credit scale. So they actually set up in Kosovo they set up a program for buyers and sellers there. And they actually matched together. And I asked them to write an article about this for our newsletter because I thought it was fantastic. And in a way, the Estonian market is a little bit like that because it's much smaller and you know each other. But it's something that can be scaled upwards and downwards. Now, for the buyer, it really is. It's a way of really cementing the relationship with the supplier, making your supply chain more resilient. We've heard that word this morning, making it much stronger. I go back to my example of Nissan that we did at Sumitomo, where we had 26 suppliers. That was quite a big supply chain. Remember, when you're making a car, as we've seen at the moment, because there are no chips or there are no wiring harnesses, I think they all come out of Ukraine, the whole production has stopped, right? So it's very important. You can't have a car that doesn't have wheels or has wheels but doesn't have a windscreen, right? Everything's got to be there. So the resilience of that supply chain is really important. These suppliers are small generally compared to the buyer, but they're absolutely critical. Essentially what the buyer is doing is bringing in its own bank, its bigger bank, which also the supplier, whatever the cost, the supplier wouldn't have access to those sorts of banks. And the final point here is slightly controversial. It helps mitigate the impact of term extensions. So a lot of programs actually effectively become bank financing. I'll show you one very good example of one that we did at SMBC where we moved the extension term from 3 months to 3 years. But that's where we get into the difficult area of how you account for it. I suspect in a lot of the smaller markets that the accounting is not such an issue. But that is what you can do with this kind of product. Okay, so this is one of the examples. So, this I've anonymized this, but this was a semiconductor company. Their problem was that they needed a better credit rating. They're a rated company. They needed to improve their CCC. So in this case, I go back to the point I made about SCF being an ecosystem, being a range of options. In this case, actually, what we said to them is, look, we will buy your receivables. And that obviously, so that improved their DSO, and that meant that Moody's were much happier with them, that their cash balances were much healthier because, as you can see there at the bottom right, there was a concern that their cash balances had actually reduced. And that was, so the result of this is that they were upgraded to A from BAA. Now, that's again one of the benefits of using supply chain finance in its broadest sense. This is the other one I mentioned. This was a satellite company. So this was a payables program, and this was the one where we moved the term date from 3 months to 3 years. So this was a critical supplier. The satellite manufacturer needed panels or whatever it was from a critical and unique supplier. There were no alternatives, and so they had to pay 3 months. Right. So we moved that to, sorry, I said 3 years. We've actually moved it out to 5 years. And this is what we call SMBC milestone financing. It helped them with their cash flow. In terms of accounting, after the 3 months, this was very much bank debt. But that didn't matter because the important point here is that they had to improve their capex. They had no choice but to pay on very short payment terms. But it had a big impact on their financials. So we moved it out to 5 years. You can see here from the bottom right box, that resulted in a big improvement for operating cash flow. So the problem here was capex. This was a major company, but the issue here was capex. So here payables made sense. In the example before, receivables made sense. So I just want you to remember to keep that in mind. Technology. And this is a slide taken from a recent WTO paper called, it's about trade tech. And it's really what we're going to be talking about here. Technology really enables us to do all these things a lot better. So to transform supply chains, as I've said, this is about the resilience of the supply chain, something that Ian Brown mentioned. The visibility and the transparency of supply chains is important in the physical management. If the cost of trade is reduced, it's also facilitated. Those reduced costs benefit banks, they benefit buyers and sellers. So it's a benefit that cascades throughout the whole system. In the slides that we'll talk about tomorrow, I've actually got some more stats on that. But the point is, and again, this is a very good example of the new business models that we're talking about. Sustainable trade, the technology enables us to attach ESG ratings. This has already been done. You're all aware probably of the fair trade kite mark, and that. But how do you know that throughout the supply chain, every part of that supply chain is going to be ESG compliant, basically? We all heard the phrase greenwashing. One of the ways of doing this is to attach ESG ratings to actually monitor this in real time. We have a fantastic member in ITFA called Coriolis. I don't know if Rebecca is on, but what they do is they use public data for exports and imports. So they use what's called HS codes, harmonized system codes. They will tell you what the goods are. So if company X says, and they're unique to the goods. So if they say, well, I'm exporting free trade mangoes, that's a different HS code from ordinary mangoes, right? And so you can see that from the publicly available data. You have to have the system to capture that and to analyze it. But that's one way in which the technology can help here. Resilience, I've mentioned, the responsiveness and the risk management. Financial crime risk mitigation is also important. Again, the transparency means you can attach KYC, AML functionalities, a lot of tools in there. For banks, that's really important, and it's really important also to limit the number of systems that we use. I can tell you, my own bank, it costs about $40,000 to KYC annually a customer. That's a big cost. Now, I hope nobody from my bank is on, because I think that's too much. But I think the technology, and I think many would agree, but the technology will enable us to reduce that. It's also about inclusive trade, all right? So as we can move down the credit curve, as I said, a lot of these sort of women and micro, small MSMEs can be included. It makes it feasible to do that in a way which it was not before. So technology is, it's so exciting, really. And there's so many ways in which it can help just the financial and the physical supply chain. And it's one of the reasons why I get so passionate about trade digitization. Okay, so one of the ways in which receivables finance can be digitized, this is not an advertisement for Marco Polo, but this is using blockchain. You'll see there in the middle, Corda, who run that's the blockchain system commercialized by R3, another one of our big members. But you'll see there, and it's a busy slide, but the basic point here is that this is all being enabled through a blockchain system. And if you follow all these boxes here, it's all about the documents or the data. I wouldn't say documents, actually, because that's one of the big things. Somebody told me, I said, don't speak about documents, speak about data. And data records and electronic records. And increasingly, that's what we have to get away from. Actually, the document to so many people evokes the physical bit of paper. But it's the data that's flowing through all these different boxes. You see there in the middle, there's an insurer. So again, my point about risk mitigation, everybody can sort of jump on this platform. Now, this is a bit of a dream state for Marco Polo, because they don't have insurers yet, but this is the dream state actually for the whole of digitization. The thing that comes out of this, and it's something we may discuss later on in the conference, is how do we achieve this? Is this through a couple of big platforms, or is this through an interoperable ecosystem of a lot of different small suppliers? So I'm sure Lever ID would rather it was the second solution. The first solution, though, is the dream state of people like Marco Polo, the fintech that I'm on the board of, Comgo, which is moving from commodity into trade, wider trade finance. That would also be their dream tech, because if you are the backer or the founder of that one platform, you become the new Bill Gates or the new, well, he's old news now, the new Elon Musk or mini Elon Musk. There's a lot of money to be made there if you've got the successful platform. I think at the moment it's too early to tell which way it will go, but this is what the technology can do for you. So whether this is done broadly across the whole of trade or just between the members of that particular platform, this is what can be done. And this is a way in which finance is provided through Marco Polo. So one of their modules is called Payment Commitment. And Payment Commitment is essentially a digital replacement for a letter of credit. It's essentially actually a sort of a promissory note. And what happens here on the left-hand side is that the buyer, at the request of the buyer's bank issues a commitment. So that's like a letter of credit, right? This was actually conceived of by the German. I'm sorry, we shouldn't. Tim said we shouldn't be nasty to the Germans, but do we have any German banks? Yes. Okay. So this was actually conceived of as the replacement for the BPO, the bank payment obligation, which was not very successful. Right? That was an ICC and SWIFT effort that was not successful. The German banks, though, loved it. So what happens in a BPO is that the bank is a bit like a letter of credit. The bank agrees to pay, so it removes the credit risk of the buyer. The difference here is that all the records are digital. So there's a matching that goes on. You'll see there in the middle, the logistics, the purchase order, the invoice, the shipment, everything is matched through the Marco Polo engine in the middle. And the buyer's bank can finance that, a bit like discounting, your own letter of credit. Equally, the supplier's bank on the right-hand side can also finance, and what they're buying is the credit risk of the buyer's bank and not the buyer. So, and all this happens digitally. Now, the problem is all of this you have to be a member of this platform. So it goes back to the point that I'm making about platformization versus the open ecosystem. But conceptually, this is how it would work. And let me show you actually again. I've taken this from something we've done internally. But this was actually in the Middle Eastern context. This is a replacement for a bill of exchange. So bills of exchange are very popular in the Middle East, promissory notes and bills. And the reason for that goes back to what I was saying earlier on about understanding and precedent. So they've been around for 150, 200 years, either through French or British laws. And so they understand that. I'm told in Dubai, if you don't pay a check, you go to jail. In Jordan, we've got our Jordanian friend. What happens if you don't pay a check in Jordan? Right. So okay. So you're moving. Right. Okay. So you're moving away from it. Yeah. So in a lot of the Middle East, this is the reason why checks are popular. But the problem, of course, is that a check or a bill of exchange or a promissory note, it doesn't matter what it actually is. It's a paper instrument. You've got to handle that. There's all the couriers and what happens if it's lost and so on. Now, over time, the forfeiting market did come up with solutions, but it's still clunky. So here on Marco Polo, you can see the saving in time. This moves much faster. I think don't bother about all the detail, but everything moves a lot faster It's a few days as opposed to 21 days at the top. Okay. So that's all the good news. The slightly mixed news, it's not like a good news, bad news joke, but the slightly mixed news is about the accounting problems that we've had. And this is, again, I think I'll preface this by saying this is probably less of an issue in this market, but certainly has been a huge issue in Europe and in North America. And the problem is how you account for it, how transparent the use of supply chain finance is. So if you take my example of the CapEx deal that we did at SMBC, where we moved from 3 months to 5 years, that's a huge extension. That's a huge payment extension. Those 3 months originally will have been accounted for as trade payable. Okay, and that is treated more kindly by the rating agencies in financial reports and so on. So when you look at a company, because people expect you to pay your trade debts, it's not a debt to a bank. One of the big worries about supply chain finance is that it's effectively an invisible way of banks providing liquidity, and it can be withdrawn at any time. And there's a certain amount of truth in that. Especially true if you think about the 3 month to 5 year example. That effectively had to be structured as a loan. I know because I had to write all the documentation for it. Effectively had to be structured as a loan, which means there were events of default, which means we could ask for payment earlier. Now, that's not unreasonable, and commercially that's what you have to do. But the question is, does that become bank debt? And that's the real issue here. And the real problem was that a lot of companies were, the rating agencies would say, misusing this. They were actually financing themselves largely through the use of supply chain finance. But when you looked at their financial records, it didn't appear. And so there were two. This is what we called there were two companies where really this came to the fore. One was Abengoa, which was a Spanish, still is actually, because I think they survived their insolvency, their restructuring. They're a solar energy provider, and then Carillion, which definitely has not survived. That was a UK outsourcing, a very big outsourcing company. And they used this massively. So there were, Moody's raised the bell on this, rang the bell. With this paper in 2015, reverse factoring has debt-like features, and oh my God, there were like heart attacks all over, all over the supply chain finance community in London when we saw that. And actually, we went to see them in ITFA, and you can see there, because what they were saying is we are going to basically reclassify any supply chain finance program that we know about as bank debt, and we said no, you need to be a bit more nuanced. And they sort of accepted that. They said it had to be case by case, and adjustments would be non-standard. So it wasn't going to be programmatic, because at one time they were going to change their whole methodology. But nevertheless, this thing has gone on. And Carillion was really so let me actually go to Carillion. So Carillion, 98% of their cash inflow was through their payables program. Now that's huge, of course. And nobody knew this. So when you looked at their records, all of this showed as trade payables. Now they also increased the payment terms to suppliers. They put a program in place. So they sort of said, well, look, I want to show 120-day DPO, but I'll put this program in place. It won't cost you anything. And what happened is actually, and this is one of the complaints from the rating agencies, is actually this was the buyer, although this should come at the cost of the supplier, because you're discounting what the receivable is. Actually, a lot of the cost of this was effectively borne by the buyer. And they didn't like that. Now, we issued some guidance on this in ITFA, some sort of flags to help you assess what's going on. So you have to look at whether the payment terms are being extended beyond the industry norms. That's difficult, because what is the industry norm? They've moved out from 30 days. There's a bit of a backstop certainly in Europe because of the late payment legislation. The buyer assuming the financial cost, security, that happened, I think, especially in Abengoa. The large size of the program compared to the liability of the bank. I mean, of course, you need to know what the size of the program is, and that wasn't always obvious to the rating agencies. Whether or not that finance facility is committed or not. Now, all of these are they're all factors you need to bear in mind. As a bank, you may not care very much. All right, and here that may not be actually a worry for the corporate. Sure. Yes. The bank may care reputationally. It may care reputationally, and of course, it may care if it's only one of the banks that's providing the program, and there is then this liquidity problem. So if you take the Carillion case, where 98% their cash flow was down to their program, that falling over is obviously going to be a huge liquidity problem. And there, I do accept what the rating agencies have said. And there is this reputational issue now in the UK. Unfortunately, as I was saying to some people last night at dinner, there is supply chain finance has had some very bad press recently because of a man called Lex Greensill, who essentially missold some assets into some funds set up by one of the big Swiss banks, and they fell apart. They had to be supported by insurance. The insurance wasn't there because of losses. That wasn't orthodox supply chain finance. I've done loads of webinars and written about this, so you can find this on the ITFA website. And there was also a very big political angle in that a former prime minister was one of the advisors to Greensill. So it's had a bad reputation. Now, it's interesting, since the fall of Lex's company, that vacuum has been taken up very rapidly by some of the big players in this space, specifically in that case Tallinn. But that is the orthodox supply chain finance. So very much what I've been talking about, where you've got big buyers, the Walmarts, the Tesco's, and so on. But there is a reputational issue. Abengoa, there was a parliamentary investigation. So the rating agencies were sort of not too, picked up on this big debate, and there was a big sword of Damocles hanging over, big uncertainty hanging over the market, which is would the rating agents, would the accountancy standards board. So this is in the US, the FASB, and for those who use IFRS, the IASB. Would they actually automatically reclassify all supply chain payables as bank debt? Now, after a lot of lobbying from us and a lot of other people, they said no, that wasn't going to be automatic. But what they essentially wanted was transparency. And it said the third point is really important, because had bank debt, had supply chain finance debt had to be reclassified as bank debt, that would have had a major impact on banks. Possibly not in this region, but certainly in Western Europe. So that fortunately didn't happen. Unfortunately, the FASB has been more accommodating. The IASB, which is what most European companies will use, a bit more demanding in terms of the transparency and some of the disclosures that you have to put into now. But that has come, and I think it's a good result. As I say, it could have been a lot worse, so I'm relatively relaxed, and that's the case of most of my members. The new regulations, there was some consultation on this. That's finished now, and we expect regulations by the end of the year. And this will have probably a smaller impact on this market, but it won't be without any impact. This I won't mention, because that's all about ESG, which I already talked about. And finally, if you like me and you like what I've talked about, we'll be talking a lot more over 2.5 days at the ITFA conference in Porto. You'll be in good company. That's our sponsors. Okay, are there any questions? Are there any questions on the pad? No. Okay. Any questions from the audience? Yes. Oh, question on the pad.
Oh, there is a
Michael.
question on the pad. I do beg your pardon. I didn't see it on mine.
Got to use the technology, Michael. Okay. While you were walking up.
Do you want to read it out?
Do you want to read it?
Maria? Oh. You need to read it into the microphone. Okay. Right, I'll read it out.
Now it will be on, yes. And I will read it out because I liked it and I voted it and someone else did. So 2 people like the question, so it means 3 people are interested in the audience.
Great. Hope I can answer it.
Why should a buyer offer payables financing to its suppliers if it is already operating at industry standard payment terms, as most large players are? Doesn't this seriously limit the potential customer base for financiers offering funds for payable financing?
Okay, so I mean the reason that a buyer would want to do that, even if it was offering standard and short terms, is that the terms can be made even shorter. So there was an investigation into supply chain finance in Australia, and it was generally negative. That, by the way, is where Greensill started. So Lex Greensill is an Australian. So that's where it started, and they were on the whole critical about it. But what they said is it does have benefits. If you're a supplier and, for example, you want to expand, or you want to offer bonuses to your staff, or you have your own supplier that you need to pay. Go back to my example of the satellite manufacturer. Okay, if you've got a critical supplier who's offering you something that's much better than anybody else, but he demands very short payment terms, by offering supply chain finance, you can actually potentially offer that to him. You can go and say, well, look, you want 10 days. I can't give you 10 days, but we'll work it out through the program. That's one thing. The other thing is, as well as ensuring the resilience, and that's an important theme of this morning, the resilience. So in some cases, you may actually want to force your suppliers to take that finance because you don't want them to fall over. If I take the example of the car, of the Nissan car, where you had 26 suppliers. If one of them failed, and some of them were very small, if one of them failed, then you couldn't manufacture the car. So in some cases, you might actually want to force some of your suppliers to take supply chain. That's not popular and that's not common, but sometimes you actually need to be quite strict about these things because you are critically exposed to them. The last thing is that you can, through bank finance, again, we go back to this point about how do you account for it, but leaving that to one side, you can push out your own payment terms. And let's leave aside how you account for it, but you can push it out potentially quite far. So it benefits you. The point is, again, it's a win-win. Yeah.
While you were answering, someone else liked the question as well, which I would take as also your answer. Okay,
they like my answer. Thank you. It came at the same time. All right, I think we are over, so
thank you very much, Sean.
I'll finish there. Thank you.
Don't go away. Got a quick question for you. Well, first of all, I'd like to mention your dazzling, amazing slide that you put up. And
it was the greatest slide.
I did notice a couple of people fainting in the audience when you put it up. You had the BPO on there. Has that now disappeared?
Sorry,
the BPO, has that now gone completely?
No, so BPO does still exist. This is an ICC and SWIFT creation, bank payment obligation. It still exists. It's not very widely used. And sorry, there was a German bank in the audience. Is that right? Are you going to be brave enough to tell me if you use BPO still? No? Okay. But the German banks do like it, but they wanted to move, they realized it had become a tainted. I
think Commerzbank was
Commerzbank, yes,
a big user.
Yes, they're a big user and a big force behind Marco Polo. But the BPO had become a bit tainted. It was a bad brand name in the end, but it's still around.
Yeah. Okay. Sean, you've worked really hard this morning. I think we should give Sean a round of applause. He's got a break this afternoon.
I haven't finished though.
Oh, you haven't? There was more. Okay.
Thank you.